Guys, welcome back. This is part 2 of real estate versus stocks. In the first video I gave you 3 advantages real estate had over stocks, and in this video I got 2 more for you. So let's get moving right along. Now let's go ahead and take that $100,000 that I gave you as an example in the stock market, and let's say you want to pull money out of the stock market to be able to use for another investment. You would generally have to sell some of your shares to be able to cash out. And with real estate, you wouldn't necessarily have to sell your property to be able to cash out. And to give you an example, let's say you've put some money into your property and you've raised the value up, so you force the appreciation, like upwards. And maybe over time, you've had it for a while, and over time the value has gone up as well. What you could then do is go back to your bank and ask them for another loan. So let's say you get the property appraised and maybe it's gone up $25,000. You can go back to your bank and say, hey, look, I'd like another loan on this property, for $10,000 more. And the bank is happy to do that for you. And so you'd be able to cash out, say, $10,000, which is not considered income, so it's not taxed. And you take your $10,000 and put it into another piece of property to buy yourself another asset, again, using other people's money for leverage. So in that case, you're actually financing 100% of another piece of property without the money that you may have earned from work. So there you go again. That's another advantage real estate has over stocks. Now the fifth reason, or the fifth advantage, is the tax advantages. Let's go back to the stocks that you have, and say that it was $100,000 and the value of those stocks went up $20,000. If you were to pull that money out, you would actually get taxed at a 20% tax rate of capital gains tax, which is a pretty hard hit by the government. And with real estate, any income you make off your properties, say you have your properties rented out, that income is actually taxed at the lowest possible rate because it's passive income. And that, again, that's a huge advantage over any other type of income that you make. Now, on the next level of that, if you were to sell that property and made a substantial profit, what you could then do is take that money and put it into another piece of property. It's called a 1031 tax exchange. Now, if you've ever played Monopoly, you get the idea of 4 green houses equals a red hotel. And what you want to do there is buy another piece of real estate that maybe is a better cash flowing deal. Maybe it's a multi-unit apartment complex, and it cash flows a little better. So using the 1031 tax exchange, you would essentially be able to defer taxes indefinitely. And again, that's another huge advantage. Also with real estate, if you're running your investments as a business, you would be able to write off any improvements you've made on that property as a depreciating asset. So you'd be able to write it off as any other business would be able to write off, office equipment or anything of value that depreciates. Well, when in actuality, property generally goes up in value. So those are the 5 advantages. Thanks for watching, and be sure to check out the website. It's www.cashflow-kcmo.com. Thanks a lot. Bye.